77 million ounces of registered silverbacks, 550 million ounces of paper claims. That is a 13 to 14% coverage ratio. That level has held below 15% for 6 consecutive months. Those two numbers do not coexist without consequence. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, the COMEX vault system is entering May delivery already stressed. Let's get straight into it. There is a number inside the COMEX system most never track. It is called the coverage ratio. It measures deliverable metal versus paper claims. Registered silver sits near 77 to 80 million ounces. Total open interest sits near 550 to 575 million ounces. That is roughly 7 ounces of claims per ounce of metal. The data is direct. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. CME Group COMEX registered silver inventory, 77 to 80 million ounces. Open interest 550 to 575 million ounces. Coverage ratio 13 to 14%. Effective late April into May delivery window. This follows a major drawdown in January 2026, 45 million ounces removed in 1 week. That equals roughly 26% of registered supply. The pool never rebuilt after that event. The unusual detail is duration, not the drop. The persistence at low levels. The timing is what deserves scrutiny, not the event itself. The timing. 6 months below stress threshold without recovery. Think about what that sequence actually means. A system designed for liquidity now operates with constrained deliverable supply. So the question becomes simple. What happens if delivery demand spikes again? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time silver inventories faced rapid drawdown, prices moved sharply higher within months. That pattern has repeated historically. The data is already telling you something. Let's build it out. Now let's build the full picture, because COMEX inventory stress does not exist in a vacuum. The Silver Institute World Silver Survey 2026 has dropped. Over 762 million ounces removed from above-ground stocks across 5 years. Source: Silver Institute. The projected 2026 deficit is 46.3 million ounces. That is the 6th consecutive deficit year. Annual consumption exceeds production each year. Now connect this to COMEX. Registered inventory remains near 77 to 80 million ounces. That is historically low relative to demand. Now add industrial demand. AI hyperscalers commit $715 billion capital expenditure. Source: Meta, Alphabet, Microsoft, Amazon filings. Prior year was $375 billion. That is near a doubling of demand drivers. Silver demand rises through electronics and infrastructure. Now bring in ETF flows. Commodity ETFs see $11 billion outflows since March. Silver ETFs alone see $1.4 billion outflows. Source: Trading Key Data. That removes speculative pressure from paper markets. The rate of physical demand is not slowing. It is compounding. The data is doing the talking. The ones who were dismissed for calling physical tightness are not saying much right now. And here is what makes that picture even harder to ignore. Registered silver remains near 77 million ounces. Open interest remains near 550 million ounces. Coverage ratio stays below 15% for 6 months. At the same time, speculative ETF positions are declining. That is not a contradiction. That is the setup. Physical supply remains tight while paper positioning resets. And before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here's the number most people are not talking about. The 10-year Treasury yield sits at 4.35%. That is down 10 basis points from recent highs. Source: U.S. Treasury data. At the same time, the DXY index drops below 98. Source: ICE data. That is the lowest since late February. Now add geopolitical risk. Iran negotiations remain unresolved into the weekend. Oil prices react to every headline. If oil moves above $120, inflation expectations rise again. That feeds directly into yields. Markets are still pricing partial stability. Look at yields at 4.35% and the DXY at 98.22. Think about what that sequence actually means. When markets price lower yields and weaker dollar, metals gain support. Silver reacts faster due to industrial demand. Every time dollar weakness combines with supply constraint, metals move higher. It has not been different yet. Now bring that back to COMEX stress. A weaker dollar increases global silver demand. That increases pressure on already constrained inventories. Sit with that. Silver Western spot holds near $75.89. Shanghai physical trades near $81.88. That is a 937 premium. That confirms physical tightness. Short-term picture remains unstable into Monday open. Iran headlines drive binary outcomes. If Iran tensions resolve, oil drops sharply. Yields fall below 4.1%. Dollar breaks under 97. Silver likely moves toward $85 to $90. If Iran escalates, oil spikes above $120. Yields push above 4.5%. Dollar rebounds toward 100. Silver trades down toward $65 to $70 range. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. This environment is headline-driven and unstable. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Oil above $120 raises inflation and pressures metals. Dollar strength toward 100 reduces global demand. Falling open interest improves coverage ratio temporarily. The bull case is equally real. 6-year supply deficit removes inventory cushion. COMEX coverage ratio below 15% signals stress. Shanghai premium confirms physical demand exceeds supply. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one conclusion. The COMEX system is operating with constrained deliverable supply. Physical demand continues to pull against that constraint. Convergence between paper and physical remains unresolved. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group, Silver Institute, Shanghai Gold Exchange, logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.